Hello guys, welcome to a new video, and today I want to discuss a strategy which is called put credit spread. It is also known as a bull put spread, and how I made use of this strategy recently on Tesla stock and made a quick $32 something. And this is a wonderful strategy if you have a small account, because the example that I'm gonna show you that required only $250 in dollar amount, but I made $32 profit on that. So in percentage term, it was like a 12.5% profit in just 2 days, right? So that is a wonderful return on your investment. So let's see how you can execute this strategy in Robinhood platform. Okay, so I'm in my Robinhood platform, and this is a Tesla stock, right? So let's quickly check on the trade that I made, right? So if I come to my trades right here, as you can see, right? So I opened this put credit spread on Feb 5th, right? And I received a $47 credit, and then I closed it today. Actually it was for $15, right? So I made this $32 profit in this, and I closed it early, even though the expiry was set to 16th, but I already made around 70% profit on this, right? So I thought we'll close this out and I'll wait for a pullback. Now coming on to the strategy, this is a wonderful strategy in current market scenario, especially that the market trend is kind of a bullish. So any pullback that you get, right, that would be a very good time to do this strategy, because the market is overall in a bullish trend, and that's what I kind of made use of in this trade, right? So if you see my trade here again, that's what I did. So I opened this trade for $170, right? 170 and 167. And don't worry if you don't understand this, we're gonna discuss this very soon. And that's what I took, like 170 as the base. And because that day Tesla kind of took a dip after the earnings, and that's when I opened it, right? So any kind of dip that you see in today's market conditions, that would be a nice time to open this kind of a trade, right? Okay, now let's discuss how you can execute this trade. So the first step that you do is you go to the Tesla options, right? You go here, and the very first step you have to do is you select sell and put. Make sure that these two are selected here, and then you can choose expiry date. So let's say just I'm gonna just do a weekly in this case. So we'll select the next week, which is Feb 16th expiry. And when you come down here, right, if you can maybe if you wanna go little safe on this, you can kind of go down here. All this means is, let's say if I select $180 here, right, all this means is what you want is you want Tesla to close above 180 come Feb 16th, right? So on Feb 16th, if Tesla is more than $180, you make the 100% profit. That's all it means here, right? But if you just simply open a sell put, right, look at here that how much you have to put as a kind of collateral, right? So you would be putting almost 18,000 as collateral, right? So as you can see here, right, if you go continue here, you can see how much capital is required, right? So you can see here, right, that your max loss is 17,800, because you are collecting this 194 as the profit here. So that's why it's showing 17,800 overall. If you are opening 180 strike, that means you can multiply 100 to 180, and that's $18,000 you would need. So where this strategy comes in to play is to reduce that capital amount, right? What you can do is you just buy a put. You do buy put, and you buy a put right below that, right? So you buy a put here. Okay, so that basically the difference of these two strikes, that's kind of your overall max that you can lose in this trade, right? So that's your kind of a capital that is required. So as you can see, right, this is a $250 spread. So your max loss is 194. Why is that? Because it's 250 minus your this credit that you are instantly getting, right? So this is as you can see, Robinhood also says it's put credit spread, right? So what it did was, earlier you needed almost $18,000, right? But now you only need $250 to execute this trade. And if you look at the percentage wise gain, right, you are just putting $250, but you are making $44, right? So if you calculate that, right, in terms of percentages, so let's see how much percentage it is, right? So if you do that, so that's kind of almost 17%, right? So 17% is the gain that you are getting only in a week time, right? That is a wonderful gain. Although it is little aggressive, you can go little safer here. This delta, as think is pretty, yeah, this is 25, right? So if you want to go little bit more safer, I think anything below 20 delta, I would say, is safer. And there is one more thing that you can do is or you can increase the width of the strike, right? So right now I'm just choosing the $250 right here. You can, instead of this, you can also choose to go with 175 and 180, right? So that kind of widens your strike prices. So now it's the $500 bet, right? So you are putting $500 at risk, but you are gaining $89, right? So you are making $89 by putting $500, right? So that's the kind of strategy it is. It's a very good strategy if you want to grow your small account. All you need is you can just do the $250 as well, right? That's the only capital that you would need to execute this strategy. Now once you have selected this, you can go further, and it also says Robinhood also shows a very nice graph that you can see here, right? So it shows you what is your max profit, what is your max loss, and what is your break even price, right? So all the details it shows. You can review again, right? And as you can see, right, the collateral you need is $250. And in terms of their two leg strategy, right? So when you opened $180 and then you bought back the 177.5, right? So that made this as a spread, and it is a strategy there is a lot of trader use, especially a very good strategy, like I said, in a bullish market that it is. And what you have to just do is you find out a good base or a horizontal kind of a support line for a stock, and if you know that stock well, you can establish maybe a month long horizontal support line and take that as a basis. Like I said here, 180, right? So if you think that Tesla would not go below 180, you can do here. Or if you think that Tesla might go below, let's say 180, but it would not go below 175, you can start your, instead of starting at 180, what you can do is you can lower your strike, right? You can just start your strike price, instead of 180 you start at 175, right? Your profit would be less, but your risk also would be less. So that was it, guys, for today's video. If you have any question related to this strategy, or if you have any stock that you think is a good fit for this strategy, please put your comments down in the comment section, and I will try to answer all your questions. I will talk to you in my next video, guys. Till then, happy investing. Bye bye.